Hi, this is KZSU, Stanford 90.1 FM. This is Laptop Radio. I am DJ Michelle. Today's topic will be on cryptocurrency. I have John Silvestro and Jerry Fuqua here with me. And just a lot of questions about crypto right now. So John and Jerry, why don't you guys introduce yourself again?
Sure. So I'm John Silvestro. I'm a active duty Marine Corps officer and pilot. Also an associate with Luna Capital, which is a cryptocurrency based hedge fund here in the Bay Area. And I'm here for my second episode with you, Michelle, and we're welcoming Jerry today.
Hi, I'm Jerry Fuqua. I'm with the Octalysis Group, a gamification consultancy, and associated with VLab, in the past founder of surgery.com and Internet Information Technologies and WorldPoint Interactive. I'm riding shotgun actually today because Tony couldn't make it because of an obligation. And that's it.
So let's get started. The first question I have is on transaction fees. What are they and how are they determined?
Yeah, sure. I'll dive in on this. So, sorry about the microphone is moving. Okay. So, transaction fees, it's been a lot in the news lately because a lot of people coming into cryptocurrency, especially lately, are noticing the high transaction fees that have been a part of the network lately. And Bitcoin, over the holidays spiked all the way up to a median transaction fee of about $30. Some of the other coins are also seeing high transaction fees these days, like Ethereum, even Litecoin, Monero. Some of these other larger altcoins or cryptocurrency assets are also seeing large transaction fees. And it's important to understand, what they are, why they have been increasing in the recent past, and maybe some solutions to the problem. So right now, when you're looking, we talked a little bit last week or the last episode about the blockchain and the block size, and we talked a little bit about mining, but we didn't dive that deeply into it. But essentially, what a transaction fee does, it's a fee that is associated with your request to have your information or your transaction written onto a specific block of that Bitcoin for that Bitcoin block. And in this case, we're going to use Bitcoin as the blockchain of choice. So essentially, if I want to send Jerry some Bitcoin, I will. In the old days, back when there weren't that many people using the network, I could send it to Jerry. Each block is written every 10 minutes or so, and so my transaction would be written on the next block, and the transaction fee would be very low. It would essentially just be there as an incentive for the miner to write that onto that particular block. As long as the blocks are not full, then you have a situation in which you can keep those fees very cheap. And this pool of transactions, if you will, is known as the mempool, which is short for memory pool. And this is something that I was thinking about today. And Jerry, I'm going to kind of give an analogy for it, and then maybe you can kind of correct me as we go through it. But the mempool, the memory pool, you can think of as almost like an airline, right? So if you want to get on the next flight, and it happens to be a popular route going from to, let's just say, San Francisco to Aspen during the winter, and people want to go skiing. There's a big dump of snow, so everybody wants to go to Aspen that particular day. So when that happens, and is the case of Bitcoin, a lot of people want to get on there. So the airline is going to take the highest bidder, essentially, and that's what that transaction fee is. During less popular times, like yesterday, for instance, we saw the transaction fees come down considerably over Christmas because people weren't sending as many transactions. There wasn't much demand for it. The price of the ticket of that same airline comes down. So now you think of this airline, it's sending a flight off every 10 minutes. Okay. You can either decide to go standby, so you're going to pay a lower fee, or you're going to provide less demand by providing a smaller transaction fee. And if that flight doesn't fill up, then you can get on that flight for your low transaction fee and hop a ride in the next 10 minutes or the flight after that. If you missed that flight, you missed that first 10-minute flight, there will be another one after that, and you can, again, try to go standby, or you can raise your transaction fee to try to get onto that flight. And this is happening every 10 minutes with Bitcoin. So every 10 minutes is another, essentially a flight, or this block is getting written to the blockchain. And in order to get on it, you can pay a very high transaction fee to guarantee you'll get on it, or you can try to pay a lower one and hope that the demand isn't so high that you get bumped to the next block. Does that kind of make sense, Jared?
Yeah. The transaction fee is actually an optional fee. It was in the early days. The motivation for miners to do the work was through the bounty that was offered. If the miner won the lottery, they would receive 50 bitcoins as a bounty. Today, that's no longer true because there are so many people trying to get their transactions into each block. It does vary depending on the hour of the day. Sometimes there's less traffic and you can get in for a much lower fee. And sometimes, like I think Tony referred to this a while back, he bought some bitcoins from another friend, another John. But the John forgot to put in the transaction fee, and so it took him a few days before his transaction went through. But it did go through eventually.
Yeah, and there was a famous transaction. I think it was $150 million, and this was back, 2012 or 2013, and they sent it for 0 bits. So they were able to send $150 million, transact $150 million across the internet for 0 fee. I mean, if you tried to transact $150 million in U.S. dollars right now, sending it anywhere, even sending it from one bank account to another, it would cost you a considerable amount of both time, energy. Lawyers would dip their hands in. The banks would get their cut. The transaction fee itself would be high. A wire transfer of that amount would raise some eyebrows. With Bitcoin, you can do it. It can still be done. Like you said, it can still be done cheaply, but because it is because it's becoming more popular, and because there are more people that are wanting to transact or wanting to send Bitcoin from one place to another, the transaction fees are going up, which is something that the core developers are working on, and all these other developers are working on to find new solutions for this problem. But it does sort of lend itself to what is the question? How do we solve the scalability issue? How do we solve the next hurdle for Bitcoin?
Yeah, I remember back in 2013, the Winklevoss twins actually brought this up in terms of the belief that the original Bitcoin network was supposed to be frictionless, essentially no resistance for a transaction. And so some people are not completely happy with these increased fees because that's creating friction. For small amounts, it's more onerous than before. For large amounts, it's not too big of a challenge. It actually, has an advantage, in it's much better, a much greater preference to traditional forex trading or remittance systems in clearinghouses.
So, how about the issue of forking? It's so confusing, and there's so many people talking about forking.
Yeah, so forking in yeah. So we've seen this now with Bitcoin a number of times. I think there's I've lost count, but there's Bitcoin Gold, there's Bitcoin Diamond, there's BCash or Bitcoin Cash. There was the Segwit 2X was the one that got turned off back in November. So there have been a number of these, and essentially forks can be used for a couple different for a few different ways. So one is the hard fork, and so that's what we saw with Bitcoin Cash back in August. Bitcoin Cash versus Bitcoin was sort of an argument of these big blockers, known as big blockers or blockers unlimited, which was we want to raise each size. We wanted to raise the size of each block in order to allow for more transactions per second or per block without getting the congestion and the fees that we're talking about. So that's a hard fork, because when you were done with the fork, there were two separate assets that were no longer backwards compatible. There was a lot of concern about BCash when it came out because there was some issue of whether it was going to have malleability or there was going to be able to be essentially hacked because the code wasn't wasn't as rigorously tested as Bitcoin had been. But needless to say, Bitcoin Cash became two different assets. Slightly before that, there was the implementation of SegWit, or what's known as segregated witness. So segregated witness was what we call a soft fork, which is basically Bitcoin forked off its original, forked essentially off the original chain to implement segregated witness, which was a new, essentially a new way to store information on the blockchain, and then fork back onto the original chain, so that it is backward compatible. There aren't two assets now on the back end. There's Bitcoin original and there are SegWit wallets, but the Bitcoin itself is backwards compatible onto both of those. And we have seen segregated witness is really exciting because it allows for new protocols to be put on that people are working on, such as the Lightning Network, which I think we'll talk about a little bit later. It also allows for, well, actually, to go back to my analogy about airplane. So segregated witness allows for essentially 4 times the amount of transactions in a single block with 100% SegWit enabled wallets and SegWit enabled transactions. So it's as if the airline was able to say, okay, I'm putting all the people on a diet, and then we can get more people onto each airplane. It's kind of, if we were able to, if American Airlines would say, hey, you need to lose 3/4 of your body weight before you get on this plane. That's essentially what SegWit does, these transactions. It cuts out a lot of the information. It cuts out essentially the signatures and stores it onto what's called an extended block, which allows for more transactions on each block, and allows for new protocols to be implemented, namely the Lightning Network, which is probably the thing I'm most excited about in 2018.
I think the important thing to remember here is still the same airline. Maybe 2 planes are running on a slightly different passenger onboarding, but it's still the same airline.
Exactly. Yep.
Okay, I think I got that.
Hard fork?
Yeah, right? I don't know. We'll see. Hard fork, soft fork, it's all very... Yeah, there's a lot of words out there that get thrown around, and that's my basic understanding of, the importance of a hard fork versus a soft fork. And we're going to see a lot more of them, and that's the other thing, is that, that they're going to continue, and you only need a certain amount of consensus to create a new fork, and like we said, Bitcoin Diamond, Bitcoin Gold, Bitcoin Cash, Ethereum Classic. There will be more and more of these as people kind of continue to move forward and see what comes next.
Awesome. I think of them as branches.
Yeah, there you go. Yeah, yep.
We could actually create a forking map for all the cryptocurrencies, and it would kind of be like a tree.
Yeah, absolutely. It looks very similar to a tree architecture.
Okay, next question that I have is a really, really easy one.
No such thing in crypto.
And it is really the war between Bitcoin and Bitcoin Cash. Is there a civil war going on there?
You want to take this one, Jared? At least for now?
No, just remember that this is a hard fork. Bitcoin Cash is a hard fork, so it's essentially like creating a new airline to compete with the original airline.
Yeah. And so the issue with Bitcoin versus Bitcoin Cash. So there has been, it really depends on who you're talking to and who you're asking. There are a lot of promises that are being made by Bitcoin Cash. They say it has 8 times the amount of capacity in a single block. They say that the transaction fees will be will be drastically lower, and it'll be instantaneous, which are just fundamentally untrue. So, and this all sort of comes from a few big players in the Bitcoin community, namely Roger Ver is one of them. Jihan Wu is another. Gavin Andreessen, I believe, is part of that team as well. I could be mistaken about that, but really the name that people are throwing out a lot right now, and the one that I would say is sort of leading this charge is Roger Ver. Roger Ver was once known as Bitcoin Jesus. Back in the early days, he's one of the early adopters of Bitcoin. He is one of the first people to invest in Bitcoin entrepreneurs and Bitcoin businesses, and he has been a real evangelist for this for Bitcoin for many years. In the last year or two, he's sort of become a bit of a pariah especially with Bitcoin maximalists, because he has been pushing this BCash and blockchain or block size unlimited and moving for bigger blocks, which I believe, and I think a lot of people who believe in Bitcoin, is a threat to the decentralized nature of Bitcoin. And some of his claims are just flat out wrong. So he went on CNBC, I believe it was 2 weeks ago, right when CoinBase, which started offering Bitcoin Cash, which we kind of always knew they were going to do. They were going to have to issue it or allow it to be traded at least by January 1st, but sort of out of nowhere, they just released this onto CoinBase. I think it was last week. And at the same time, Roger Ver is on CNBC essentially saying that Bitcoin Cash is instantaneous and free to transmit, which are both incorrect. It has essentially the exact same architecture as Bitcoin, so it's still, no matter how fast you're going to do it, you're still looking at 10 minutes as almost a minimum. I mean, if you put it into the mempool right at the very end of a closing of a block, you might get it in faster than that, but generally speaking, average transaction time is still 10 minutes. And you can look all this stuff up. It's on, if you go to bitinfocharts.com and you take a look at, if you take a look at bitinfocharts.com, and it has on there average transaction fees, average transaction times, it's all on there. And unless BitInfoCharts is a propaganda network for Bitcoin, maybe their information is wrong. But from my own personal, so I was curious about the numbers after he made that claim, and so I went on there and I crunched the numbers, and we'll post a graphic of what I came up with in the link to the video. But basically, what I found was not only is Bitcoin Cash not cheaper, nor is it faster than Bitcoin, but at the same transaction volume. So if you look at when Bitcoin was doing 5,000 transactions a day, or when Bitcoin was doing 10,000 transactions a day, or 100,000 transactions a day, which Bitcoin Cash has maxed out at about 125,000 transactions so far, is the most it's done in a single day. If you look at days in which they had the same transaction volume, Bitcoin was actually 19 times less expensive to transact in terms of transaction fees. So Bitcoin Cash right now is actually 19 times more expensive. Now that's if you're comparing, it's impossible to compare these things right now because they're completely different sizes. It's like saying this 747 is the same as this Cessna 172 airplane that's trying to, take, one's trying to take 400 passengers, the other's trying to take 2 people and their bags to Tahoe for the weekend. You just trying to say that they're the same and saying, oh, well, Bitcoin Cash is cheaper. Well, yeah, Bitcoin Cash is cheaper because only 100,000 people are trying to use it. Whereas Bitcoin, you got 400,000 people trying to transact in it every 10 minutes. And so making that comparison between the two is just disingenuous. And I think what this is really teaching me, and again, doing my own research, and what's taught me about the issue going forward is that on-chain scaling is a myth. On-chain scaling is not possible to have this be what we want it to be, which is a global payment system, maybe, or a global store. Well, again, it depends on who you're asking and what they believe the true vision of Bitcoin is. But if we believe it's going to be a global method of transacting value between people, then on-chain scaling just does not work. I don't care if you have 10 terabyte blocks that close every 15 seconds, and it still doesn't scale on chain. And that's when we start getting into scalability issues. We talk about off chain and near chain and those kind of things, which we can get into as well. But I guess my overall point on this is that Bitcoin Cash versus Bitcoin is this quote unquote civil war that is being pushed by mainstream media or others, whoever has an agenda to push these kinds of things, and a lot of people who are new to the space and new to cryptocurrency and new to Bitcoin are buying into it because they see, okay, I can transact with Bitcoin, it's going to cost me $15, let's say, or I can transact with Bitcoin Cash and it's going to cost me $1. They think that people just assume, oh, there's no difference between the two, so that's why I'm just going to use Bitcoin Cash because all I'm seeing is price right now. And I think, you compare it to a premium product versus a non-premium product. And yes, $15, $20 is a lot to transact. And it prohibits people from buying coffee. It prohibits people from transacting for small things. But if I want to securely transact $1 million right now, then I would do it in Bitcoin in a heartbeat. I would do that way before I did it with Bitcoin Cash or really any other chain at this point. Now, can we solve these problems as we move forward? I think absolutely. I think we are in the very early days of this, and we have really exciting things coming out just in 2018 for Bitcoin. But all that being said, I think that this sort of, like I said, civil war, quote unquote, between Bitcoin and Bitcoin Cash is really being drummed up by a lot of people who have a stake in which one wins. In the end, maybe Bitcoin Cash does win. Maybe Bitcoin wins. I think, though, that the real lesson from these two is that you have to do a little bit of homework and realize that there are big differences between the two, and just saying one is cheaper to use than the other is disingenuous and it is not accurate to say.
I'll just add a couple of comments. First, the developing groups for both Bitcoin and Bitcoin Cash consist of a lot of very, very bright people, very knowledgeable people. The group for Bitcoin is much larger, not necessarily more experienced, but much larger group. The other thing is, before August 1st, if you had a certain number of Bitcoins, you can essentially get the same number of Bitcoin Cash tokens or coins, and then you'll have essentially two accounts, two funds, and you can play around with Bitcoin Cash and investigate it, look for it further. You can even trade back into Bitcoin with Bitcoin Cash, but don't go the other way. At least not now. Don't try to buy Bitcoin Cash coins with Bitcoin. That's not advisable. Wait until Bitcoin Cash proves it is a superior coin in some way before you venture into it. It's a very dangerous path to take.
And I think we forgot something, Michelle. We should have reminded ourselves earlier today, which is that neither Jerry nor I nor Michelle are financial advisors, and so this is for entertainment value, this is for entertainment, and this is for information, but this is not advice either way, any which way. We're going to be talking about ICOs later. We'll be talking about Bitcoin Cash and Bitcoin. My thoughts on this are mine and mine alone. I am not a financial advisor, and Jerry, I think you would echo that sentiment as well.
Ditto.
I don't think any of us is, and Bitcoin and cryptocurrency is really highly speculative right now. So you got to do your own research and understand the risks and do your own research on any of these companies.
Absolutely. And
I would go so far as to say that if anybody is claiming to be a cryptocurrency financial advisor, an expert, take it with a grain of salt, because there's not enough history, there's not enough experience right there to really support that kind of statement.
Yeah, I agree. And but all that being said, with Bitcoin Cash versus Bitcoin, I think that you're looking at Bitcoin Cash, which is a very small group, and their developers, the ones that they have, are strong, but there are not nearly as many people working on Bitcoin Cash as there are working on Bitcoin. And then if you have the secondary layer people and the tertiary layer people and the people who are working on the networks that are going to accept these payments, I mean, the number of people working on Bitcoin versus Bitcoin Cash is really it's really hard to kind of overemphasize how many more people, how much more work is really going into that Bitcoin network than the Bitcoin Cash network.
I wanted to talk a little bit about scaling on-chain versus off-chain. What is the infrastructure for scaling right now? Do you think that will change in 2008 and beyond, 2018 and beyond?
So I think that the scaling thing is probably the most interesting thing that's going to be happening in 2018. And like I said, if this has taught me anything, this Bitcoin Cash versus SegWit 2x versus Blocks Unlimited versus whatever, as we see these transaction fees start to go up right now, as we've seen them really go up from, they were less than $1, only 8-9 months ago, all the way up to a median Bitcoin price or Bitcoin transaction fee of almost $30 a week ago or a week or two ago, which coincidentally or not, happened to coincide with this Bitcoin Cash release and this CNBC stuff, and a lot of people, would say it was almost an attack on Bitcoin. But what I will say is that it has shown us that clearly, no matter what model you go with, scaling on chain is not going to happen. And the reason it's not going to happen is it would be like, so scaling on chain would be similar to every time you wanted to send an email. You'd have to download the history of the world's emails in order to go and send your own email. Or if you want to get Starbucks coffee, you'd have to download the history of every Starbucks receipt that Starbucks has sold before you could buy your own coffee. And they'd have to look at it and then add yours onto the back and then send it out to the world again. And then the next guy would come up and he would order his coffee, and they'd have to take all the receipts, staple your receipt on, and then send it back out to the world again. It's just not feasible to think that we could scale in that way, especially with right now. I mean, in the world, I think it's less than 1% of the world's population owns any real crypto or owns any Bitcoin. If you want to scale to where it's anywhere near, 10, 20, 30, 40, 50%, which some people estimate that in about 9 or 10 years, you're looking at 50% of the world's population will be utilizing cryptocurrency in order to transact between individuals and institutions. Then you're going to have to come up with something that works at a bigger scale. And there are some projects out there that are working on. I think the one that is probably getting the most excitement right now, and the one that I'm most excited about is called the Lightning Network. So the Lightning Network, there's a lot of people use analogies like Bitcoin is like a highway, and we're going to make the highways wider, or we're going to build more highways, or we're going to create more off ramps and on ramps, and all those things kind of work to an extent, but we have the same issue here in California. The more accessible you make the highways, the more the highways get used. The more they get used, the more traffic gets on there, the worse the traffic gets. And that's what we're seeing here with I-280 and the 101 here in Silicon Valley. But the Lightning Network is sort of, in terms of analogy, I mean, it's basically inventing teleportation. I mean, that's what you're talking about. You're talking about taking the cars, instead of worrying about cars, you're creating a teleportation mechanism for people to transact instantaneously off of the chain, and then it being written onto the chain later. And we can talk more about the technology behind that and the specifics behind it, but you're really talking about a technological leap in blockchain technology. And that's what Lightning is at least promising to do.
Yeah, I think the scaling barrier, the big problem right now is that the current Bitcoin network, I believe, is supporting about 3 transactions a second.
I think it's 7 is is the last one I heard. But yeah, Bitcoin's about 7 per second.
Yeah. When you compare it to something like Visa or MasterCard, which are on the order of probably 10,000 a second. I
think, I actually just looked this up today. So I think on average they're at about 4,500 to 10,000 per second, but they can scale during peak demand up to 65,000 per second. Mm-hmm. So that's what you're looking at. But that being said, so Visa has been increasing that number linearly over the years, right? So it sort of does this linear progression. It'll probably be 100,000, the next 10 years or so, and then maybe it'll move up a little bit more as more and more people come online and they get these. But Bitcoin, with the Lightning Network, you're looking at parabolic return. So right now it says 7. So they're doing 65,000 and we're only doing 7 per second. Well, you never catch up. Yeah, well, okay. So we move forward a year and now it's 14, and then you double again, and it may not be on that scale of every year. Maybe it's every 6 months we double, right? Yeah. So 14, and then we move up again to 28, and so on and so forth. And then by the time you actually hit parity, where the Bitcoin network can handle the same number of transactions per second as the Visa network or MasterCard or whatever payment system you want to choose, 6 months after that, it's already doubled that number. So let's say they meet parity. Let's say that, just for argument's sake, they make parity at 100,000 transactions per second. Bitcoin catches up, and now they're at parity. 6 months later, Bitcoin will be 200,000, and 2 years later, it will be 10 times the amount of transactions per second that Bitcoin network will have over a Visa or a MasterCard. Mm-hmm. And that's really saying something incredible, because what you end up with in the long run, as these things start to scale, is you end up with essentially streaming money. And that's a really interesting idea, right? Because instead of thinking about it as transactions, same way that the internet used to be these, packets of information to you and then packets of information to me, and back and forth and back and forth. And that's sort of what the Bitcoin is right now. But today we have streaming internet. We have streaming music. We have streaming video. We have streaming virtual reality. We have streaming data. And that's what the Bitcoin network, and that's what's really interesting, I think, about when we're talking about Bitcoin, because it really is a new technology, right? It's a brand new protocol that we are still just in the early days of. But we do have this schema of the internet that came before it. And if you draw similar parallels, people are looking at Bitcoin Cash, to kind of go back to Bitcoin Cash versus Bitcoin as a scaling mechanism. Bitcoin Cash is looking to solve the scaling issue by essentially adding more tubes to the original computer.
So,
right.
John, I think I have a friend here on Facebook who has a question and listening to us. And he just want to confirm that you're saying that over the long run, some speed can be added in that's exponentially faster than Moore's law.
I'm sorry, can you repeat that one? What I'm saying is that it's going to be faster than Moore's law?
It'll be faster than Moore's law.
Well, I mean, you could use Moore's law, but Moore's law is a hardware problem. This is a software problem. Software does move a lot faster.
There are a lot of things that are faster than Moore's law.
Yeah, I mean, so yeah,
Please
so I mean,
just a different way.
Moore's law is great. I mean, absolutely, Moore's law. I think at one point it was 18 months. I think it's moved up a little bit. It's like 20 months or something like that now. But Moore's law is a hardware issue, and hardware is much more difficult to scale than software. Software scales at software speeds. It scales at the speed at which developers can come up with new protocols or utilize new math, and not only that, but now because we're all connected to the internet, you have even faster solving of problems that seem intractable, only a few days ago or only a few months ago, because you have this sort of hive mind that can come in and create new solutions to what would seem impossible problems just 6 months ago are now solvable by the amount of people, the amount of brain power going into each of these problems.
I'll make an observation too.
Yeah,
the original white paper is viewed as maybe being deficient in terms of scaling, but it's not really a deficiency. It's more of an inadequacy. But the thing is, if you compare it to the original development of the internet, back in the late 60s, early 70s, when it was the DARPA net, they anticipated that there was going to be about 10,000 connected computers in the entire world, and they would grow slowly. And that turned out to be incorrect, but that didn't prevent them from developing new protocols, new formats, TCP/IP and HTTP, a lot of other technologies to increase the speed and bandwidth of the entire internet. So similar, this is what the promise of Lightning offers. It promises the ability to scale up and to make things much faster.
Social media also has another question, and it's a follow-up question.
Okay.
So his name is Barry. Why wouldn't this apply to competitive networks?
The scaling issue?
Yes, the speed issue.
So, why doesn't it apply to Ethereum or Bitcoin Cash or Monero or any of the other ones? Well, it does. And I think that's a misunderstanding that people have is well, wait, we're not seeing this sort of increase. But if you look at Ethereum, and you can go to BitInfo charts as well, and I highly recommend people go there and check it out, because you can do a lot of your own sort of research. But if you go to BitInfo charts and you can look at the increase in price, transaction fee wise, of all the networks, Ethereum has seen a large spike in its transaction fees. Bitcoin Cash, if you look at transaction volume versus transaction fees, it has also seen a spike. It was almost at $1 the other day, which again is neither free nor instantaneous. And I think you will see, and I guess that was my point earlier, which is it doesn't matter if it's Bitcoin or Ethereum or Monero or whatever blockchain or whatever on-chain coin or asset you're talking about. If you get enough demand for it, eventually they all run into the same scaling issue.
John, how about Visa?
What about Visa?
How about why hasn't Visa grown? Or has Visa grown?
Well, so we were talking about before, so Visa has been able to grow at a linear progression, but comparing Visa to Bitcoin or any of these decentralized cryptocurrencies, you're talking about just completely different assets, right? You're talking about a centralized payment system, which in the short run can be grown in a linear fashion at a faster rate, and it can also be grown. It can also be more efficient. So a decentralized network, by definition, is going to be when we're talking about on scale, when we're talking about on chain, is going to be less efficient, and more expensive.
So the question is really why isn't Visa scaling as fast? And I think we need to first talk about the differences between what is physical and what is not physical, because I certainly used to work at PayPal, and I think Visa was catching up from cards to payments, and now cryptocurrency is just really different.
Right. Well, and I think it is important to say, when you're comparing, the only thing that's important in terms of comparing Visa versus Bitcoin is just saying, the number of transactions. But the systems are so completely different. I mean, you're talking about a decentralized open ledger in cryptocurrency versus a centralized closed ledger, which nobody can look at, nobody can read. And on top of that, something else that's also important, and this is something that I didn't really understand. And again, this has been a long education for me, both in money and currencies and how our monetary system works. But with Bitcoin, once your transaction has been confirmed. So first of all, people are like, oh, it takes 10 minutes. But the reality is, once I say, like, I'm sending it and it's been sent to the blockchain, that transaction can be looked at and it can be verified that actually happened almost instantaneous, within about 5 to 7 seconds. Now, it might take as long as 20 minutes, 30 minutes, 40 minutes for it to confirm, but that means that, that transaction, I can say, hey, Michelle, I sent you $10 and you'll have it in 20 or 30 minutes, but it's on there and I can't take it back and you're just kind of waiting for it to confirm. With Visa, that is not the case. Sometimes transactions can be almost 30 days for it to confirm, 2 years that it can be out there until somebody says, can somebody go back and say, you know what, I want to buy back, that's a fraudulent charge.
Yeah,
chargebacks. Chargebacks, exactly. Yeah. And that was one of the big problems, PayPal had that issue.
Yeah, PayPal's
Bitcoin, is solving that issue. But after those 30 minutes or so, that's it. Like it's confirmed, it's on the block, and we are finalized in our transaction. Whereas with Visa and these other cards, I mean, yes, they provide 60,000 transactions a second or whatever, but at the same time, those transactions aren't actually confirmed for 30 days, a year, sometimes 2 years out. You can still get those chargebacks, and so it causes a lot of issues for mom and pop stores or for people who are trying to do transactions, because you don't really have that on the books until that time lapse has completely gone by.
Yeah, so if you actually go and look at how the funds circulate to different institutions, that's completely very different from the blockchain and the Bitcoin and the cryptocurrency. So we're eliminating a lot of these old systems.
Absolutely, yeah. I mean,
well, also when you're comparing Visa to cryptocurrency, you're talking about a mature market versus a new market. So the growth rates, how they react and everything is completely different.
Well, and to just hit on that scalability issue. So if you were in a computer scientist, or if you were a student studying computer science, back in the early 90s, your professor would have probably told you the internet can never scale to do what you want it to do. They would have probably said it's physically impossible because of the physical limitations of the internet under the protocols that we have. We'll never be able to send that amount of information over the internet because the packs of information are just too small and they won't be able to send. And so people are saying the same thing right now about Bitcoin, right? They're having the same. You're using a schema from what you've seen so far to try to predict how the future is going to look, and it's just not possible unless you open your brain up. You try to use some parallels from what we've learned in the past, and again, I think the internet is a great parallel for this, because it is one of those things where you would say, I can barely send an email, I can't download a picture, I can't do any of these things that they say I'm going to be able to do. I'll never be able to shop. I'll never be able to watch TV on it. I'll never be able. And now today, and we're still in the early stages of what the internet's going to be capable of, And we're again in Bitcoin. There's no reason to think that we won't solve these sort of scalability problems. I think Andreas Antonopoulos talks about it a lot. He says, the internet failed to scale for 25 years, and look what we've got now. Bitcoin's been failing to scale for the last 9 or 8, and we're just getting started.
In the 1990s, there was a conference, Asian Pacific Communications Conference, which actually had dignitaries from Washington, and they were talking about scaling in terms of optical fiber for the backbone. And they were talking about hundreds of gigabytes of bandwidth. And they often said, well, this is probably not necessary. This is way overkill. We'll never use that much. Now we're talking about hundreds of terabytes of bandwidth.
Well, and I told a story the other day, too. So my good friend Josh Davis gave his nephew a new computer for Christmas. And it was a terabyte hard drive. And when I was in college, I went to Johns Hopkins, where they control the Hubble Space Telescope, and we had this amazing tour. As director of NASA, the director of NASA at the time was giving us their tour, and he's walking around, and he goes, "Oh, I got something really cool to show you guys. Come here, come check this out." And so we walk around this corner, and there's this, looks like basically the half of a refrigerator, black box sitting there in the middle of a room, in this cold room. And he's like, "Does anybody know what this is?" And you have to remember, this is 2002, so. We're all like, I don't know, some kind of storage or whatever. We kind of, knew it was a server, but other than that, I didn't know what he was talking about. And so he goes, this is a terabyte hard drive.
I think there will be a convergence.
Well, yeah, but I guess my point is, like, I didn't even know what I barely knew what a megabyte was at that point. We were still in kilobyte floppy disks almost. And this guy's talking about a terabyte. And now I literally, in my computer, in my bag that's sitting right here on the floor, I have a 2 terabyte hard drive that's about the size of my iPhone. And so, again, that's more Moore's law kind of thing. If you put that into the idea of software, it's even faster, and the scalability goes even faster. And I'm really excited to see what happens in 2018. I think there's some really exciting technology that's going to be coming out for really all cryptocurrency, but Bitcoin specifically. And the Lightning Network is a great example of that. And Lightning is being tested. It's already been tested on the testnet. Actually got tested on the mainnet, I believe, today for Bitcoin. And Lightning has been used on the Litecoin network as well, and there's no reason to think that most cryptocurrencies won't adopt this new technology.
You might want to tell them what the test net is versus the real.
Oh yeah, well, anybody who's accidentally sent real ether to the test net on Ethereum. Not saying that I did that. I mean, I wouldn't be so stupid, obviously, but there are test nets out there that allow people to test different new technologies or otherwise without necessarily testing it on the real Bitcoin chain, and putting real Bitcoin at risk. So you can get fake Bitcoin essentially, or testing Bitcoin, or testing Ethereum, or testing right now I'm working on a new net called Grin, which is the test net for a new technology called Mimblewimble. And using your terminal on your iOS, you can go in, you can test it, you can mine sort of this test net Grin, this test net Bitcoin, testnet Ethereum, whatever what have you, and it's a completely separate chain from the real Bitcoin. So it allows people to sort of, without consequence, test new technologies to see if they will work.
Let's move to the next question, which is Bitcoin a bubble? Should people freak out? What should we think of that?
Well, when you say bubble, the first thing that comes to my mind is, where does it fit on the hype cycle? And I actually wrote a paper about 3 or 4 years ago about Bitcoin, and it was addressing the concern about this. Is it a bubble? And the problem was we didn't know where it was on the hype cycle. Right now, it's been through several hype cycles, and it keeps surviving. So, yes, there's going to be a bubble, but it's going to recover, and there's going to be a new bubble in the future, just like the internet.
Yeah, I mean, is Bitcoin a bubble?
Wait.
No, sorry.
Wait. Is the internet a bubble?
Yeah, that's good. I think it's a similar question.
Well, actually, they were talking about the web. In the 90s, they said, okay, is it a bubble? And yes, it was a bubble. And in March 2000, the bubble burst, and the value of all the transactions, all the commercial investment in the web was reduced by half within a few days.
Yeah, I mean, I think Amazon crashed by 90% or something like that. But
they came back.
But look what Amazon's doing now, and I think you might see something similar. I mean, some people think that is what 2013 was, sort of this Bitcoin false start. So you had Bitcoin released in the white paper written in 2008, gets released in 2009. Only a few people know about it before 2010. Starts to gain some traction, and then it ramps up in terms of. No, we're just talking price. I mean, which is really the only way we have to measure sort of what we're talking about right now when we're talking about bubble. But there was a lot of technology kind of being brought into it, a lot of people being brought into it, a lot of interest. The price spiked all the way up. I think it hit about 1,300 at one point, but let's say it's 1,000, and then it crashed. From 2013 all the way down. So in 2013, it hit about, like I said, 1,300 or 1,000, crashed all the way down to 200. I think 187 was the absolute bottom. And then it kind of entered what we refer to as this crypto winter, really, where it sort of stayed there, kind of fluctuated between 200 and 400-ish for a number of years, from basically 2013, 2014, all the way until 2015. You started to see the price start to climb up slowly, and then 2017 really was this gangbusters year where it really took off. And yes, even this past week, if you look at what happened over the Christmas holiday, when late November, early December, the price spiked all the way up to 19,000 or so, and then it crashed all the way back down to 11,000 this past week, and now today, it's back up to 15,000, 16,000. You just got to look at the time horizon is really what it comes down to.
And some people viewed it as a crash. Other people said, no, that's just a correction.
It's a correction. It's a consolidation.
It just goes ins and out.
Well, and
to
give you a little bit of perspective, I think I don't know exactly how many times, but I think this year alone, in 2017 alone, there have been crashes of 25 to 30% or greater 7 different times. So, people last week, and I love these stories when you see it on, especially when you see it on CNBC or mainstream or any sort of central news network that only reports on this thing every once in a while. Now, you can go to places where they have tons of great information on this, and they're constantly updating, and they are used to these sort of crashes. But every time one of these things happens, 1 week they'll say, oh my God, Bitcoin's up 20%, and then the next week they'll say, well, it recovered 10%, but don't forget it was down 30% last week. They always kind of plug that in there, and it should be realized. And Jerry, brought this up earlier, which is the volatility and the risk profile of this asset cannot be overemphasized. I mean, you could very easily put your money in tomorrow, and it'd be worth 30% or 70% of what you put in today. But at the same time, the growth from if you go back on the time horizon, if you zoom all the way out, or even zoom out 6 months or a year, Bitcoin's up 25 to 30x in a little over a year. Ethereum is up 89x in a little over a year. Litecoin is up 86x in a little over a year. And that's not investment advice. I'm not saying you should go put your money into any of those things, but over enough time horizon, these 30% dips don't really add up to much when you have 30 or 40 times your money in a little more than 12 months.
And during this discussion, we're totally ignoring volume. If a price correction might be a very low volume correction, and it has different effects. The similar analogy I like to throw in here is like if you had invested in Pan American Airline, and then it went through the crash in 1990 or so, you lost everything. It disappeared. But then would that deter you from getting rid of Apple stock in 1995?
No.
Yeah, because if you kept your Apple stock, you'd be very well off today.
Yeah, for sure. And I think Amazon is another great example of that. I mean, if you had gotten in at the height of it, it would have hurt like hell because you would have lost about 95%, and it would have taken you 16 or 17 years to recover that investment, which probably not the kind of the horizon you're looking for. But if you would somehow held on to your Amazon stock all the way through to today, you're sitting on a very, very healthy return. And I think Bitcoin, you're seeing similar dips and troughs and these long extended time periods possibly, but you're seeing it on a much more truncated time frame. I mean, just to go back to, like I said, Amazon, if you bought at the very height in, I think it was 2000 or 99, whenever it was, you would have had to wait 17 years to get your money back. If you had bought at the height of Bitcoin in 2013, you you would have only wait 2 years to get your money back. And then if you waited just like 2 years and 6 months, you'd have, about 15 times your money. From that time frame. So you're seeing these bubbles and bursts, and they're happening, at a pretty regular rate. I mean, if my estimate's right, and it's 7 times over the last year, you're talking about once every month and 7 days or so, month and 8 days, 9 days, something like that. You're going to see one of these things. And so over the course of, but it's recovering much more quickly too, because you're also looking at, and this is, to come back all the way back to the original question, is it a bubble? So the way that I look at Bitcoin, the way that I look at this technology is you are not looking at a standard commodity or security that is bubble and bust and representing some underlying technology. It is the technology itself. So you are seeing an adoption curve of this technology rather than a price curve of a underlying security or commodity. So when I like to talk about Bitcoin, I like to talk about, what I think could happen with the price or what could happen with the adoption. I'd rather compare it to the number of Facebook users over time, or the number of Google searches over the time, or the number of emails sent over the time, as opposed to the price of Microsoft or Apple or one of these tech stocks that's had these huge swings over the last 20 or 30 years. I think it is a much more important to think more about, are people going to adopt this? And if they're going to adopt it, the price goes up. And I think you're seeing a lot more people entering and staying than you're seeing people enter, lose some money, and leave. Those people aren't holding because they don't believe in that underlying technology. And so, the thing that I always tell people when they're first getting into this is like, buy a little, and we covered this last time, was my takeaway after the whole thing was, buy a little Bitcoin or buy a little cryptocurrency assets, whatever floats your boat, whatever you think you want to invest in. But then start learning. And that education is going to pay off so much more, because when you really realize what this is, and you realize what the possibilities of a truly decentralized international cryptocurrency that is digitized and and has the possibility to be instantaneous and almost free to send anywhere in the world, you start to realize this is just better money. This is better money, and solves a lot of problems that we have in a system that because we are, in this country, we're in the U.S. and we have this great financial system that allows us to do things like Venmo and PayPal and send money instantaneously to each other using a centralized network system. We don't really understand until you start digging into it and realizing what these problems really entail, that this is a world-changing, powerful technology. And when you start educating yourself on that and you realize it, then those returns that you're talking about can come, because you start feeling more confident, more comfortable in investing maybe a little bit more of your net wealth into this. Now, not saying anybody should go out and invest their whole net worth, but I am saying put a few bucks in it, put a few dollars into it, invest a little bit in it, and then once you invest in it, you start to see it grow. You start to educate yourself, and then you start to grow more. You educate yourself more, and it's just this self-fulfilling adoption prophecy, which eventually looks like an S curve. And if you want to Google S curve or technology or technology adoption S curves, you'll kind of see what I'm talking about.
So, John, we have a question from social media.
Okay.
So the question is, why not the number of transactions over time instead of speculative price?
You mean in terms of the scalability that we're talking about, or the demand for it?
It's both.
Well, I think you'll see. Pretty clearly that those are almost. I'm not going to say they're 1-to-1, but my guess is that. Well, first of all, the price is a lot more interesting, right? So I can get a headline out there that says Bitcoin hits $20,000, a lot better than Bitcoin hits average transactions of 6,000 per minute, or whatever. Like, no, who cares? That's it's much more exciting to say Bitcoin's hit a new price threshold than Bitcoin has hit average transactions in a given time period. But I think that's a good question. I think that we should be looking at average transactions, because it does tell you the robust nature of the network. What I'd really like to see, especially when we're having these conversations about which coin is better than the other coin, or which one has better transaction fees or otherwise, it shouldn't be average transaction fee, because that's not comparing apples to apples. That's comparing, like, let's say Bitcoin is a giant freighter ship in San Francisco Harbor, and Bitcoin Cash is really just like a little speedboat, because it doesn't have any it doesn't have any weight on it yet, right? Like, nobody's put any weight on this thing, so it's just zipping around. It's like, oh yeah, we're free and cheap and fast, like, take a look at us. And it's like, okay, and then the freighter says, okay, here, take some of my volume, here's a shipping container, poof, the thing sinks. You know what I'm saying? So like, having that conversation is not accurate. It's not fair. So I would love to see if you could have if people would talk more about transaction fee per volume or per daily volume rather than just transaction fee, average transaction fee, because it's not fair to compare those.
How about compared to the number of emails in terms of growth? Number of emails?
Like number of total emails around the world versus the number of transactions of Bitcoin, or I mean, I guess I kind of hit on emails as like a growth metric or an adoption metric earlier. So I think that I think the reason we use price again is because price really is a measure of how much it's being adopted, and so would the number of transactions, but as transaction fees go up, especially on Bitcoin network, people are less incentivized to transact. So the price is actually a better metric of adoption, because I may put, let's say somebody puts $1 million into Bitcoin, they transact it once to put it in a safe storage space, and then they don't transact again for years. But that doesn't mean that there hasn't been an extra $1 million worth of adoption that's gone into the network, right? And I think you see the same thing with. Whereas transactions, as the fees have gone up on scaling, or trying to scale on chain at least, people have been transacting less versus the price. And so I think the price is just a more accurate representation of the actual adoption of Bitcoin rather than the number of transactions at a given time period. Now, when Lightning becomes a thing, and if it delivers on what has been promised to us, and again, these transaction fees, SegWit. I think it hit a high of 16% adoption the other day. It was a Christmas miracle that it went from like 12% to 16%, but now it's back down to about 14%, and it doesn't seem to be sustaining these SegWit transactions. And again, to go back, SegWit transactions allow for more transactions to be put in a given block. Right now, there's about 16% of all transactions are SegWit. But that could be changed if consumers understand that and they demand it be adopted by the different wallets that they use. One of the biggest problem children, I will say, in this space right now is CoinBase, and I we talked about over the Christmas break. I was talking with a couple of friends, and I definitely defend Coinbase, but Coinbase has not done any SegWit adoption. So their wallets are all still the older, more cumbersome, more information network, and so they are a big driver in these transaction fees. Not only that, but they don't use any sort of manual transaction manipulation. So I can't say, you know what, I had this transaction, I want to send $100 worth of Bitcoin to a different wallet of mine, and I don't really care if it gets confirmed today, tomorrow, or sometime next week, but I don't want it to cost more than 30 cents or 20 cents or 10 cents. With Coinbase, I can't do that, right? I can't set any sort of transaction fee that they use their own algorithm to figure out, how much it's going to cost you to send it around. And that is also driving up the price. So non-SegWit adoption and not having manual transaction fees that you can set yourself as a user is driving up the price because it's using these algorithms. And, I had a friend who tried to send one off of another wallet, Exodus, which I actually really like, but they have the same problem. I believe they have done Exodus has done SegWit, but they haven't done any manual transaction fee. It cost them $95 to send Bitcoin. One transaction. And that's, again, because Exodus has said, we want to ensure that your transaction is going to show up on the next block. So we're going to pay the requisite transaction fee to make that happen. Well, what if I don't care about that? And as a user, there are other wallets out there. Electrum for Bitcoin specifically allows you to do sort of transactions fees that are slightly, or that are very manual, or you can manipulate really all the way down to 1 Satoshi, I believe. Jax, which is my mobile wallet, I think they have 3 settings. So even if they just had, even if it wasn't completely up to you, even if they had a couple different settings, it was like, this is super important, I want to be confirmed the next block. This is relatively important, I want it to be confirmed the next 6 hours, or this is not that important that it gets confirmed that soon, like please have it confirmed in the next week or two. If they had those 3 things on Coinbase alone, plus SegWit adoption, the transaction fees on Bitcoin would come back, and I should know this number, I don't, and I'm sure there are people out there who have done the number crunching, but I would imagine they would come down by 50, 60, 70, maybe even more percent if Coinbase alone did that, not to mention all these other wallets out there that have not adopted SegWit yet. I think, but you're seeing a very slow, secure process. People don't want to move too fast because, God forbid, you adopt something that then turns out has a fatal flaw. Coinbase is huge. They have billions of dollars worth of people money sitting in Bitcoin in their wallets. They want to ensure safety. And right now, the safest thing to do is to stick with what you know. But I think eventually they're going to have the kind of consumer demand that says, hey, we want SegWit because we understand what it is now, and we want that. We want manual transactions because it's important enough to us that I'd be able to send my money without spending, $95 or $30 or even $10 or $1 to send it. I want to have more control over what I do. And if Coinbase doesn't adopt it, somebody else will, some other exchange will, and people will move to that exchange.
Yeah, I think Coinbase is just at the beginning. So I have another question from the audience here. And the question is, what about the mean time between transactions as a measure of adoption?
Like the mean confirmation time?
No, it's mean time between the transactions.
Yeah, I mean, there are definitely different ways to look at the way that, adoption can be measured. I think the price is probably the best because it does show the amount of dollars that are being put into this space. Mean transaction time, yeah, I don't know if I really have an opinion on whether that's an adoption metric or not.
Okay, awesome. I think personally, and I'm not providing legal investing or tax or accounting advice here, I think I wrote something on how I think the cryptocurrency is just getting started. And I spoke a little bit about the Bitcoin overview. And I did this on December 18 when the price was at 18,897. Market cap is 316 billion. Visa then is 257.94 billion. PayPal is 90.92 billion. Wow. Gold is 7 trillion. And then when you look at the coin supply is 16.7 million. Mm-hmm. And then just overall on the crypto assets, the total market cap, and this is on December 18, is 608 billion. The total trading volume is 38 billion per day. Bitcoin dominance is 51.9%. And there was a number, there was 1,365 number of assets on the market. And then from a very, very big picture perspective, I think the technology on the software and hardware will get better as time goes on, because there's a lot of smart people out there all over the world, because this is global now.
Yeah, and I think you just hit on something that I was just going to mention, which is comparing Bitcoin or any of these assets to single companies. You nailed it. I mean, it's an international global phenomenon, and it has international global demand in a way that these other institutions or companies, I think that Bitcoin, right? And I think Bitcoin passed Netflix or one of these other ones, and it was a big story. And it's like, yeah, it's kind of a big story, except that if we think this is going to become what I believe it will become, if Bitcoin maintains its dominance of 50% or higher, and the crypto space, the crypto assets become worth what I think they will in terms of market cap, you're talking about, Bitcoin being worth 10, 20, 30, 40 trillion dollars as an asset someday. And again, over a certain time frame, you could be looking at, cryptocurrency being worth the same as M1 or M2, which is sort of the monetary supplies that we have in this world. And you're talking about $100 trillion, $240 trillion, $320 trillion. These numbers that just they don't even really make sense to talk about them. It's sort of like talking about a one Google, for instance, one followed by 100 zeros. It's numbers that we can't really even comprehend anymore. But in terms of comparing it market cap wise, I think they're interesting right now because they are on parity with those. But if these assets become what I think they will be, and I think I think Tony would agree with me, I think Jerry would agree with me in a large sense, which is that we're talking about this thing actually completely failing and it doesn't become what it's going to be, and it goes back to zero, or it becomes a 10, 20, 30 trillion dollar asset.
Yeah, I think it's going to be bigger than some of these current companies. And then the other reasons are, I think in the U.S., crypto is treated as property and is taxed as capital gain. I think people are beginning to know about crypto now. And I think, the micro payment vertical has been a little bit untapped. So there's really rooms for startups and opportunities there. There's still room in terms of market adoption. I think people are asking, what is Bitcoin? How do we buy it? So when we have the consumer side, I think the merchant side may adopt. And then I think there's multiple uses as well. Besides micropayment, people are using it on top of Ethereum to build, other platform. And there's other platform coins such as ICOs. So it's going to be really, really interesting. Just really the diversity of use. The different kinds of coins, different kinds of company, on a very global scale. And I think the blockchain technology has not yet matured. I can see really many different uses for the blockchain. And I talk about the global virtual currency. And I think even as an investment opportunity, I think, you can buy a coin and then you can sell it. Versus traditional investment, you look at the team, you're kind of stuck.
Yeah. Well, so we talked about Naval Ravikant last time I was here, and I actually just heard a podcast with him. I think it was yesterday. It might have actually been this morning on the way to work, but he was talking about and when we're working on this as well with VLab, sort of the idea of ICO as disruption to the VC model, and the VC model used to be relatively long, right? You come up with an idea, you find an angel investor, and then an angel investor helps you find some VC money, and eventually, about 10 years down the road, you can finally IPO and get some liquidity as an entrepreneur, as somebody starting a business, right? And that was sort of that 10-year road. But after Enron, a lot of the IPOs have sort of dried up. Getting liquidity is much more difficult. And again, you have that sort of 10-year runway of time frame that you have to get to before you can actually get some money out of the thing. ICOs has I won't say completely yet, but
60 seconds.
ICOs are possibly on its way to completely disrupting that 10-year model that we talk about, because if somebody can come in today and say, "Hey, we're doing an ICO," and they can get some pre-investment, maybe they have a couple angel investors that give them money to buy some computers and maybe do some research and rent some space. So maybe a couple $100,000, something like that, and they give them some token. And then 2 months later, they can ICO.
I think I call that distributed investing.
Sure.
Because I think, to get VC funding, I feel like you almost have to be a guy, you almost have to be white. And you almost have to know, like, the VCs in Sand Hill. And, it's like, I don't know what they're looking for. But, it's kind of exclusive.
Right, you nailed that Sand Hill Road, right? You had to go with your hat in hand to Sand Hill Road and, hope you met the one guy that you needed to meet who thought your idea wasn't stupid. And then he would maybe give you a little money, and then hopefully, and it was just this sort of, these keys to the castle. There were all these different, moats you had to pass and walls you had to get over, and there were all these gatekeepers. But ICO is disrupting that, because you don't necessarily have to have all those gatekeepers. You can launch an ICO and you can convince enough people, and you can go viral, and you can have this idea that is great. And you can, still, and when you're investing in them, you're still kind of going by the same metrics, but the time frame is just truncated now. You still this is a great team because they've got, they've got Naval as a backer, they got Vitalik Buterin, or they've got, Andreas Santanopoulos is there helping them out, or whatever, or they're just some really smart guys from Wall Street who teamed up with some really smart guys from computer science world, and they've got this great idea to do a payment system, or they've got some track record. So you as an investor, you're still in the same sort of game, but it's taken away the, you don't have to be an accredited investor once there's an ICO. I talked about this years ago with the accredited investor thing, which we always, when I was old enough to realize what that was, it always made me crazy, because the government will allow you to buy a lottery ticket or go to the casino and gamble away all your money. But when it comes to investing in something that is smart and possibly a good idea, unless you have some arbitrary number like $1 million in the bank account, or you've made $200,000 over the last 2 years, you can't get in and try to invest, or they say, gambling. So they say it's to protect the individual investor. Well, if it was to protect the individual investor, why did they let me go put all my money on black in Vegas, or why did they let me blow all my money on a lottery ticket? The reality is that ICOs are taking that power away from a centralized government that says only these people can get in on the good ideas, or only these people, and those rules protected the wealthy in a large way, because it allowed them kind of first dibs on these ideas. And only until it got to IPO status and you could get on your E-Trade account and actually buy this stuff did it become valuable to the everyday person. ICOs are valuable to the everyday person the moment that it gets onto one of these exchanges, whether it's on Binance or Bittrex or CoinBase or Poloniex or Bitfinex. I mean, there's a million of these things. You can look them all up. But they allow you to, as an individual investor, put in, hey, you know what? That does seem like a cool idea. International payment systems that are cheap and instant. Like, yeah, I'll put $500 on that and see what happens. I can put $500 on black at the casino. Why can't I do this? And that's to say, that this is a 50-50 shot that your money's going to go to zero or double. And that's not the case. We're still in the early days. Yes, it could go zero. Again, super high risk investments, but it does give every individual person a chance to bet on these incredible teams and these incredible people that are putting together these ICOs.
Yeah, so I just wanted to just defend the SEC a little bit.
Sure, yeah, go ahead.
Because I do think that they have an interest in protecting the public. And, I think because of scandals in the past, they want transparency. And, the Sarbanes-Oxley as amended, and those regulations are really meant for companies listed on the exchanges to have that kind of transparency and to have some kind of check and balances between different committees. And these
ICOs, a lot of them are scams. You got to be very careful. You got to do your due diligence. And at the same time, you have to realize you're in this complete speculation. So even if you've done all your due diligence and everything checks out, and even if you hired lawyers to do some research for you and figured everything, and you took in everything you possibly could, you still could get completely burned.
Correct.
Just like junk bonds.
Just like junk bonds, or just like the '90s .com bubble was there were tons of. We saw it last week, or was it 2 weeks ago? Was it Tom's Juices or Tom's Iced Tea? Call themselves Tom's Blockchain now, and they're
Long Island.
Long Island. That's what it was.
Yeah.
Sorry, Long Island. Yeah, so it was Long Island, and they changed their name to Long Blockchain or something.
Yeah.
And the price went up 239% in one day, and that was that's a SEC traded security that all they did was change their name. And you saw that back in the .com days too. Some people were just adding .com to the end of their company name, and you'd see these prices go shooting through the roof.
Yeah, so I would recommend everyone to do your own research and read about it and find out who the founding teams are, what their products are, what their technology is, and just find out and learn for yourself. Because I think that is very important. I think, I've seen many different articles writing about how blockchain should be worth nothing to how blockchain should be worth like over 1 trillion or something in 1 year, and it's just mind baffling because how does that happen, and it's really important because I think when we have the community, we want to be responsible in terms of the information that we provide. And I think it's important that the community, looks at information more objectively so that we can protect ourselves.
Yeah, I think that's good. A lot of good points.
So lastly, let's talk about, the future for Bitcoin. What is going to be up?
So we hit on one already, which was the Litecoin network. Sorry, not Litecoin network, the Lightning network, which, if promises fulfilled, you're talking about instantaneous, basically free transactions. And I can talk more about the way that works, but there are a lot of great videos out there that can kind of explain the computer science behind that and the idea behind it. But essentially, it allows for, Jerry and I to transact off-chain basically as many times as we want in a given period. So let's say we decided that Jerry and I are going to do, for 1 year, all of our transactions back and forth are going to be basically recorded by us. And then at the end of that year, we're going to write all of our transactions at once for one fee onto the blockchain. And that's, so if we transact enough, if right now, let's say the average transaction fee is $10, now we only have to do one transaction to open our chain and one transaction to close our chain. So it's $20 for the entire year, and we can transact 1 million times. We can transact as many times as we want during that time. And there's a lot of security that goes into that. A lot of it has to do with time expirations and dates that are set, and then the signatures that we sign on each one of those blocks. But essentially, we're creating our own blockchain between the two of us that once one of us disagrees, we can either send it back, or at the end of our time that we've allotted, we can send it back. And so that sounds interesting. It's still $20 for us to transact, but it certainly saves us a lot more money than if we want to transact 1,000,000 times and it costs $10 every time. But the interesting thing with Lightning is it doesn't just have to be between Jerry and I. It can be between anybody that we operate with or transact with, and using AI, it will be completely transparent to us. We will never see. Sorry, not transparent. It will be, it will be completely opaque to us. We will never see anything that happens within that system. As far as we're concerned, we're just sending Bitcoin to each other, or I'm sending Bitcoin to you, Michelle, or I'm sending Bitcoin to somebody through a intermediary that I've never met before. But because it's a trustless system, it allows us to do that, and it allows us to do that between, a single transaction could have 230 jumps. Now, we know from decentralized networks like Facebook, I think the average distance between two people on Facebook right now is something like 2 or 3 people. So if you get enough people, 3 or 4 billion people using Bitcoin, then the number of jumps you have to make to utilize the Lightning Network will probably be on average somewhere in the neighborhood of like 3 to 4 different people. And again, this is, I'm barely getting my mind around exactly how Lightning works. I definitely recommend that people go and, look up Andreas Antonopoulos. He does some great videos on it. Stark, I believe her name is. She just did a video on Bloomberg this week where she explained, she's the CEO of the Lightning company that's hiring a lot of developers that are working on this. But again, it's open source. So even though there's a company out there called the Lightning Company, the Lightning Network, that is working on this, there are other people out there that are putting in contributions onto GitHub and are putting in their time and effort and energy. And there's enough people that have made money off of Bitcoin that want to see it thrive, that they are starting to hire their own developers or pay their own developers to work on this as well. And so that's just one of them. There's also Rootstock is another protocol that people have been talking about putting onto the Bitcoin network, and that's a competitor with Ethereum. Rootstock, I honestly can't tell you much more other than it is a protocol that will allow for smart contracts on Bitcoin. Mimblewimble is another one, which is more of a privacy issue on the Bitcoin network. Tumblebit, I believe, is another one. And then on the longer time scale, Jerry mentioned earlier that in the beginning days there was the miners used to get a reward of 50 Bitcoin for putting in their hash rate on a given block. That's come down. It was 25, and now it's 12.5. And then in 2020, you're going to see another halvening. And so when that happens, it becomes more scarce. If the demand stays the same and the supply becomes more scarce, you're going to see the price go up again. And I think in 2020, you're going to see a massive increase in both price and adoption based on that. And it doesn't get talked about, I don't think, nearly enough, because people are looking on a much shorter horizon. But, they're building Bitcoin, and this is something that someone said to me the other day, which I think is really important. But we are building Bitcoin for your grandkids, not for you. And if we wanted to, but I guess the point being, like, if you wanted to survive to that point, you need to work on it now and build it slowly, so that it's not just, hey, we built this really cool thing, it lasted 10 years, and then it totally flamed out because we didn't properly build it. And so they're building something that is going to last for generations, and we are building, and everybody who's a part of it is building something that's going to last for generations. It will be useful to us, I promise, but it will also still be useful for the world in 10 years, 50 years, 100 years, maybe even 1,000 years.
So we have another question from social media and from our friends, and the question is, I think I can answer that question, but I may not. If you guys wanted to answer it, go ahead. The question is, why wouldn't users simply use iMessage to send money from user to user and not even know the underlying technology? Well, I think that your point is well taken. I think saying using iMessage to send it doesn't take into the fact that it's a decentralized open ledger, but I think you will use Bitcoin very, very much like that. I believe so, right, too. In that you won't understand the underlying technology, and that you will just send it like it's a text message, or you will send it like it's a like a swipe of a credit card, or putting two cell phones together and sending money that way. I think you will see that, but we're in the early stages. It's just like saying, well, why can't sending an email in the 80s or in the 70s or something like that?
it was very difficult to do. Before AOL came along, the internet wasn't accessible to many people, and I think Bitcoin is going to remain inaccessible to a lot of people until the technology gets more user-friendly. And we've seen that evolution just in the last 7 years with Bitcoin.
Yeah, I mean, even with PayPal, and I'm just really talking about some of my experiences as one of PayPal's attorney there. We had texts to give, and texting way before the iPhone became a normal thing to the world.
Oh, cool.
And at that time, we're still, I mean, you can text payments. And then later on, you can send payments via email. And then later on, I'm just saying that the technology will grow, and I think it's possible in the future or very soon just to be able to send cryptocurrency to your friends via text or email.
Yeah, I mean, right now it seems cumbersome because people aren't familiar with using, private keys and hexadecimal and all that stuff, and I wasn't either, and I'm still learning, and I'm still trying not to lose my money every time I send something to someone. And I, and to tell a personal story, I messed up. We were talking about the testnet earlier. I was trying to do some stuff on this Ethereum testnet, and it said you need at least one Ethereum. And so I sent one actual Ethereum to the testnet.
One Ether?
One Ether. And it disappeared forever. And, that Ether is now worth $740 or something. You learned your lesson. Yeah, and I learned my lesson, And so early adopters, they pay a tax. And sometimes it's a tax because they're buying into something that's not useful, and sometimes it's a tax because they literally lose their money, like when they send Ethereum to a test network.
Let's go. I think we have about half an hour, and I wanted to talk a little bit about the talk about alternative coins, and then give a little bit of review. So why don't I talk about mine first?
Yeah, because you know a little bit about IOTA, and it's been in the news a lot lately, and I'd love to know more, and I don't know all that much about it.
Yeah, so we're gonna go around and just really talk about some other coins that we like personally, and this is really not meant to be investing advice or anything. I think everyone has their favorites. And for me, for some reason, I just like IOTA and Cardano. And I like Stellar too, but John's going to talk about Stellar. So IOTA means, it stands for Internet of Things application. So it's IOTA. So when we look at altcoin, we look at the team, the technology, their timeline, the valuation, just little things like that. I think the Internet of Things will expand. We were beginning to see sensors, we were seeing robots, or just really, and then also the clothes with like technology in it. I think that will expand. And then the IOTA is based on something called Tango, which is quantum resistant on the directed acrylic graph. And it's centralized. There's no fees for transaction. It's based on a fixed money supply. So anyone who submits a transaction needs to verify 2 other random transaction. So I really like IOTA. So that was one of my favorite alternative coin. The other one is Cardano, which is called ADA. Their official site is on cardanohub.org. It's led by a former Ethereum CEO, Charles Hoskinson. It's built from scratch with Haskell, which is a new functional programming language, so that it's more secure and reliable. It's decentralized public blockchain and crypto. It's both a smart contract platform and it is a cryptocurrency as well. It provides users with a new consensus called Ouroboros. I don't even know if I pronounce it right. Ouroboros.
Trees? What was that?
It's
Spanish for tree?
It's Ouroboros.
Oh, okay.
Ouroboros, which defends the blockchain against attack. Because I really think that privacy is going to be really important and security, right? And it wants to be the go-to platform for smart contracts. So I think Cardano has a lot of potential. So I like those 2 and Stellar so far.
Nice. Jerry, you
have your favorites? We're just showing our favorites.
Actually, just for fun, I think it's RXP Ripples. And that's only because I received a little card that gave me, I think, 20,000 ripples about 3 years ago. and the problem is, a lot of people got these cards and they cashed in, but they misplaced their keys and they can't find them.
So I have a story regarding Ripple. Okay, so I and Jerry went to this conference, or we actually put together a conference in, what year is that?
2013, that was the virtual currency conference featuring Kashmir Hill as the moderator and the Winklevoss twins as the investors.
So Ripple was there, and each of us had a Ripple card, and the card contains a lot of numbers on it, right? So I tried to register on Ripple, and I'm like, why is this so long? And I did research on Ripple, and was it in the talk form? I'm like, oh my god, is that part of the number? What is that? Like I still have that card.
Well, good. You still have it, so you can still cash in, right?
Yeah. I still could. But it was just a shock. It was just like you get a card with this long number, right?
Yeah, if you weren't used to this stuff, I wouldn't have known what you were looking at back then. So I would probably been in the exact same boat. Hope I would have hung on to it.
I think originally you had to create an account on
You had to create an
Ripple
account first
before you could. You had to use this very long number.
Yes.
Which was essentially like a private key.
Correct.
But that wasn't really the private key. You actually hit the internet and it generated a private key, and then you had to keep that safe. People forgot that step.
Correct. So in the good old days in 2013, it was really different from now.
Yeah, that was the pioneering years.
Yeah.
The wild west.
You got to be careful with your stuff. So I will talk about. I guess I'll talk about Stellar.
Let me.
Oh, sorry. Yeah, go ahead.
Let me throw in Litecoin. A few years ago, also we had Bobby Lee, who's the CEO of China Bitcoin, which is the big Chinese exchange, and his brother Charlie Lee actually started Litecoin, and he was able to do that from knowing very little in about 24 hours, because it was usually you just take the Bitcoin blockchain, you tweak a few parameters, and you launch a new currency, and that was Litecoin. I believe Litecoin is number five in total market cap, so it's still doing pretty well.
I like Litecoin as well, actually.
Litecoin is he claims it's silver to gold to Bitcoin's gold, and I think the interesting thing about Litecoin is the exact same code. The only difference is that instead of it being 21 million coins, I think he multiplied it by 4, so it's 84 million coins that will ever be created.
Right.
But and the block time is 2.5 minutes as opposed to 10 minutes. But other than that, that's the only difference that he's made, which is nice, because it works as a really nice almost like a beta tester for the Bitcoin network, and they've used it that way. They did a couple tests with the Lightning network on Litecoin first. They've done atomic swaps on the Litecoin network, which is something I don't really understand, but it sounds super cool. And then it has served sort of as this, and Charlie Lee does a good job of saying, making his point. It's like, look, together Bitcoin and Litecoin networks are stronger. They're not competitors. They're more of like I said, gold to silver.
Yeah, actually, I've heard him say that Litecoin is the tricycle to Bitcoin's bicycle.
Oh, I like that. Okay. Hopefully it's to its motorcycle, but we'll see.
Now,
I think we're using a lot of transportation analogies today.
I know, that's true.
The other interesting thing was that Bobby Lee said that his brother started Litecoin without telling him, so he didn't even know about it.
Oh yeah. Yeah, that's funny. But I think there's a couple other differences in there as well. I know those are the main ones. But I think there's some others that, has to do with the way the hashing is done and that kind of thing. But those are the big ones.
Yeah.
But,
Stellar?
Oh yeah, so Stellar. Stellar is actually, it's a San Francisco-based company. It's actually a fork off of Ripple. So to kind of go back, Jed McCaleb, who's the founder of Stellar, was also the founder of Ripple. and was also the founder of Mt. Gox way back in the day.
So this was a hard fork.
This was a hard fork off of, yes, we kind of hit on that earlier, the hard fork versus soft fork. So this is a hard fork off of Ripple. Jed McCaleb left Ripple to work on Stellar full time. Stellar is a cross-border payment system. It is right now the fastest confirming payment system in the world. It usually takes between 5 and 6 seconds to confirm, and they use a different model than the proof of work and mining. So theirs is known as the Stellar Consensus Protocol, or SCP. And basically, as an individual, I sort of give weight to other people within the network to believe, basically to confirm that a transaction has happened or not. It has a lot of nonprofit bent to it, so they really want to focus on banking the unbanked. So there's a lot of cool things that go into it, and I definitely recommend people read up on it. You can go to stellar.org and you can read through their entire frequently asked questions, which I've done a few times. But it creates a network that doesn't require as much energy or work to confirm all the transactions, which, because it's untested, is probably not is definitely not as secure as a network like Bitcoin or Litecoin or these others, because it is a new idea to figure out whether or not it can be as secure as those networks, and it hasn't been put under, like we were talking about earlier, the same strain as a network like Bitcoin or otherwise. But I really like their team. They have this great group of people that are working on it. They're traveling the world every day to try to get more people signed into this, and they are selling a lot of their lumens, Stellar Lumens. Lumens is the token for the Stellar network, but they're also doing a lot of giveaway of the lumens to people in unbanked parts of the world, and so the idea being that eventually this will be a very cheap transactional model for cross-border payments that is not centralized like the Ripple network. So Ripple, is a lot more centralized. It's mainly being used as cross-border payments between banking institutions and central banking institutions, whereas Stellar is more focused on the individual and trying to basically bank the unbanked and allow them to do cross-border payments cheaply and efficiently with each other. Zoom as well, yeah. And so I really like Stellar because I like their team. I really enjoy Jed McCaleb and Britt Young. They also have a network called the Lightyear Network that they're working on as well, and I think that they have some really amazing things kind of coming down the pipe. On top of that, they are also launching as a backbone for ICOs in 2018. In January, the Mobius coin is coming out on that network. They were going to launch on Ethereum, but they've changed their minds. They decided to launch on the Stellar network instead. And the Stellar network has said, we are going to be the ICOs for people who want to launch smart tokens, but not necessarily smart contracts. So with the ERC20 token, you have a lot of really big sort of attack services, because Ethereum allows you to do so many things. But because it allows you to do so many things, there's a lot of vectors that you can, there's a lot of services that you can go into and sort of attack on, because they have a lot of abilities like smart contracts and doing escrows and these sort of things. Whereas the ICOs launching on the Stellar network are more focused on, very simple economic ideas. So like doing an escrow, but also doing an inflationary coin or a deflationary coin, or doing a dividend. If you were going to do that kind of thing, it would make more sense to launch on Stellar. They're launching 3 in January. They expect to launch over 100 coins next year on the Stellar network. So for me, in terms of things that are really exciting and coming out next year, I really do like the Stellar network. I think that it is going to be really interesting to watch, to see what happens with them in the coming 12 months. And then some other ones I think we hit on, Monero. I really like a lot of these privacy coins. So Monero, Zcoin, Dash, a few others that are focused on privacy, I think are really interesting. I think there's going to be more of a demand for that. I also think that Bitcoin is going to enable some of these sort of privacy things on top of their protocol. But for now, Monero I think is interesting, and the reason I really like Monero is that they are decided to do a sidechain using the protocol called Mimblewimble, which I might have hit on last time we talked, but essentially Mimblewimble was a white paper from 2 years ago. It was looking to be launched on the Bitcoin network, but it's not technologically feasible to do so. So they are launching their own network, the Mimblewimble chain, which is going to have a token called Grin, but Monero is also doing a sidechain. A sidechain of Mimblewimble as well, to add in some blinding factors, some blinding numbers, and to make it even more private than it already is. And then finally, what was the last one that I want to talk about?
I think Jerry should talk about Doggy.
Oh, Doggy Coin.
Dogecoin. Yeah. Yeah, actually, Tony and I both got into Dogecoin within a month or two after it was launched. And what it turned out to be was a great way of raising funds for good causes. And the most famous one was the Haitian bobsled team that, to go to Russia during the Olympics. And essentially, if you've been to Haiti, there's no snow there. There's nothing, but and they needed some funding to go there. And Doge raised like $20,000-$30,000 to fly them to Moscow to compete in the Winter Games. And right now, let's see. Dogecoin is sitting at position 34 on the total coin
The market cap.
And it's actually going. Actually, it's up. But the thing is, it never really reached the levels of the more notable coins. But it still served a purpose, and that was to get some funding to people or causes in need.
Yeah, I think the other one that I'm really excited about is actually it's a new sort of asset within the cryptocurrency space, which is known as a stablecoin. So the way that Monero and Zcash and Zcoin, all these are all part of the privacy coins. There's going to be a new basic coin coming out that is known as a stablecoin. So there's a couple of different coins working on this one. I think is known as Maker, but the one that I've been following is called Basecoin. It's from a team out of MIT and Princeton, I believe, and their idea is the issue with using Bitcoin or these other deflationary currencies or these sort of stable supply currencies is that time comes into factor, right? So if I have a contract and that contract is going to be paid out over time, if I'm using a coin that has only been, only going to issue a certain amount and is deflationary in nature, for instance, like a, pay scale, right? So if my boss says I'm going to pay you, 10 Bitcoin a month, or 1 Bitcoin a month, well, that could be a really good deal for him or a really good deal for me, depending on what happens with the price of that coin. And after a month, he might say, you know what, I've got to renegotiate your contract because I can't afford to pay you a Bitcoin anymore, because now a Bitcoin, instead of being worth $15,000, is worth $100,000. Or the opposite, if Bitcoin goes from $15,000 down to $1,000 in a month, I want to renegotiate as the employee and say, well, I can't really afford to live on 1 Bitcoin anymore. I need you to pay me more. And so that's the issue, and it will always be the issue with, it's why people can't be paid in gold, for instance. And that is an issue that Bitcoin and these other coins really won't solve, because in a speculative nature, you see the volatility. You can't pay somebody when something is that volatile. Even when you get to a place where Bitcoin's only moving, maybe 10 or 15% in a year, still that's still a pretty volatile asset to be paying somebody in. And so I think that you're going to see these stable coins like Basecoin come into play, where they are controlling the price to be, let's say with Basecoin, they were going to have it be on parity with the dollar. So no matter how many people are using it or how many people want to use it, if it goes below $1, they sell these bond coins, and if it goes above $1, they buy these bond coins to keep the price at $1 and on parity with $1. And that way, people can still speculate it and still make money, but the coin itself will always stay at the exact same price. And so you can, over time, say, hey, I'm going to pay you, 300,000 Basecoin a year. And even if the price goes up and down in terms of its speculative nature, you will still just get that one price. And so right now they're going to peg it to the dollar when it first comes out, and then in years future they'll eventually switch that over to being pegged to a basket of goods, like similar to like an inflation or an inflationary coin, which I think is really interesting. I think it's something that this space really needs, and I'm very excited about that class of coins that are coming out, which are like I said, going to be known as stable coins.
Do you guys want to talk about OMG? So my friend Jerry here always makes fun of me for saying OMG. So there's a coin called Omaisgo, and their symbol is OMG. Their market cap is $1.3 billion. I think Jun Hasagawa is the CEO and founder of Omaisgo. So OMG solves the fundamental coordination problem between payment processor, gateways, and financial institution using a decentralized exchange. And it's on the ERC20 Ethereum-based token, and it can be stored on the Ethereum wallet. So that's also one of the most popular coin as well. And you can do a Google search on Omaisgo, OMISEGO, OMG, on Google, and you can find more information about that.
Yeah, I mean so there's been a lot of this stuff is marketing, right? And Omaisgo has been claiming himself as the Ethereum of China, I think, is sort of what they've been telling themselves, which I find funny because it's a token that was built on the Ethereum blockchain.
Yeah, it is.
But in the end, right? But in the end, these whole it's the blank of China, or it's the blank of San Francisco, or it's the blank of these are all international currencies, right? That's the whole point. These are supposed to be international crypto assets, and so if it's the Ethereum of China, it's just an Ethereum copycat. If it's the Bitcoin of blank, it's just a Bitcoin copycat. And I think that's important because there are going to be a ton of these assets that will eventually go to nothing. If anything of the past has shown us, the survival of whether it be a internet startup or a website or a blog or whatever, a venture capitalist is doing really well, I think, if he has a 95% failure rate. 5% is really all you have to hit in order to do well in the venture capital world. And it's going to be very similar with the cryptocurrency world, because in the end, somebody is going to evolve and become the winner. Now, because a lot of these tokens, a lot of these projects are open source, the biggest, strongest, and best one that has the best network effect is generally going to win in the long run. And I think you're going to see, which is why, a lot of people that I talk to are investing, and they're like, oh, I don't own any Bitcoin. Bitcoin already had its run, blah, blah, blah. I always recommend that people hold at least some Bitcoin in their portfolio, because there is a very real chance that Bitcoin could, become another 90, right now I think it's at, 45.2% is Bitcoin dominance. There's a possibility it could go back to 90% if it adopts all of these technologies that it's talking about, because it does have that network effect with the merchants and with consumers and with just the general recognized name of Bitcoin. When you talk about crypto assets, you say, oh yeah, I'm working on cryptocurrency, and they may look at you at two heads. But now we're getting to a point where most people do know, or at least heard of, Bitcoin. So you say, oh yeah, we're talking about Bitcoin. They're like, oh yeah, that's the internet money thing, right? You're like, yeah, totally. That's exactly what we're talking about. And I just like being, I like to try to be an educator in some way, shape, or form, and I try to learn as much as I possibly can, and then I have fun when people ask me questions, and I try to see if I can still answer all of them. The more questions I can answer, the better off I am, and the better off the people around me are in terms of being fully informed about what's going on in this world and what's coming down the pipe.
I was having lunch at Town and Country close to Stanford today, and someone asked me about crypto and Bitcoin. So just to end, what is your which is really the most valuable advice that you wanted to provide to the community? I'm asking for insights.
Well, I would actually reflect what John said, and get some Bitcoin, but try a small amount, something that you can easily lose and not care about, and just learn about it, learn how it works. It'll give you insight to the other the altcoins, and it'll make you appreciate a kind of a progressive system going forward. So that you begin to see what are the weaknesses of our current fiat currency and our banking system.
Yeah, and I think mine's probably going to be the same as it was last time we talked, with an extra caveat, which is buy yourself a little Bitcoin, just like Jerry said. But then prioritize education over speculation. So don't go out and start buying all these different coins you heard your buddy talk about, or you saw on Twitter, or Carter Thomas mentioned, or you start thinking you know something, and then 2 months go by and you realize that was a completely misunderstood belief because you didn't know enough yet. So get involved for sure. Throw a little bit of money into this. It's fun. It's one of the most fun things I've done in a long time in terms of getting educated, and there's so much to learn. It never stops. It will constantly keep you engaged. But yeah, buy a little bit of Bitcoin, and then education over speculation, because in the end, that education will make you a better speculator, a better investor, a better understanding the pitfalls of a certain project you're looking at, and then it'll really give you a chance to dive in fully and really learn as much as you possibly can about this space.
Thank you, John and Jerry, for being here today.
Thanks, Michelle.
Bye.
Thank you, Michelle.
You're welcome.